Hello, what's up, and welcome to Beauty Under Construction. Beauty Under Construction. And okay, I'm not gonna keep going because I'll stay here for a while. Today it's a different type of video. I am doing one about investing. This is something that I'm deeply into. If you've seen my, I don't know, which video do I talk about it? Maybe my manifestation.
I may be new to this, but I'm also true to this. That's what
Video. I talked about it just a little bit, and I'm gonna talk about it today. So the reason I'm doing this video today, or the reason I'm doing this video at all, is really because me and my family, we have this group chat. And every Sunday we talk about stocks. We come together, we do like a little, somebody does a presentation, and we talk about, what we've learned in that week about stocks. Today I'm going to present the slide that I did with my family because unfortunately I only got to do it then, and then nobody's gonna like talk about the slides or anything, and we're gonna go on about our weeks and days, and it's gonna be over. And I think it's a pretty slide. I put some work into it. It's pretty. So I'm gonna screen record the video. The video of what I'm going through later. So it might just look like it's not following along exactly what we're saying. Like it might not follow like the speed, the tempo. Like I might just click next, then say something, but I'm not gonna. If I say something going back to that page, I'm probably not gonna go back to that page. You get what I'm saying? I'm gonna record this screen as closely to this video as possible so that it matches along, and I'm gonna put it on like probably like right here, maybe right here, maybe right here. Right? That's not a bad area. So anyways, yeah. Once the screen record is up is when we're gonna start. So option trading made by Brianna, inspired by Robinhood, because let me tell you, I'm not gonna lie, I went into Robinhood and I copied and pasted a little bit of what I saw there, and then after that, I dumbed it down in my terms, like what I got from it, because I'm lazy. I'm not lazy. It's just the fact that like they explain it so well there and break it down so well, and it's like I watch so many YouTube videos about it and stuff like that, and I understand it, but not everybody's gonna understand it that way. So I was like, hey, let me just put the real life definitions on there that I got from Robinhood, because we use Robinhood. I'm gonna put my thing on the thing down below, my what is that called? My link on the description down below, so you can get a free stock. Yes. It's gonna take a couple of days, but like just push it through. And it's all through the government, so they're gonna ask you some questions. The government is involved in the situation, so they're gonna ask you some questions, all secure and everything like that. It's perfectly fine. It's a great app. The reason that I have to say that is because a lot of people don't really know a lot about investing or Robinhood and things like that, or and they just think, oh, it's a scam, it doesn't sound real. And I understand why. Like, you're making tons of money, and it's like, what's the catch? And it's like, it's just in trading. It's trading, and then Robinhood makes it easy because you don't have to go through a broker. They are your broker. They're the middleman, so you don't got to do no work. Robinhood. That's the only app I know. So anyways, it's not really this is not a beginner's video though. So this is that really, like, that part of the video just goes this little. It's just, I'm probably gonna cut it out. It doesn't even matter. So anyways, today we're gonna be talking about option tradings. Made by Brianna, inspired by Robinhood, like I said. So, here's a little overview about a couple of things that we're going to discuss in this presentation. We're going to talk about options, contracts, rights and obligations, strike price, premium, and knowing when to buy and sell. Okay, so what are options? Options are a way that you get to interact with stocks that you're interested without actually trading the stocks themselves. Let me re-say that. Stocks are a way to interact with stocks. Wait. Options are a way to interact with stocks without actually owning them. Yes. So when you trade a stock option, you can control shares of the stock without ever having owned them. So basically that just means when you trade a stock option, you get to sell and you get to when you trade a stock option, you get to control stocks without ever having to own them. So that's basically what I'm trying to say. It's the leverage game. So when you have leverage, you can provide opportunity for outsized gains while exposing investors to outsized losses. The leverage game. You can provide. So it's the leverage game. You can provide the opportunity for outsized gains by showing investors oversized losses because it's a larger amount. Options continued. Like I said, when I said it's a larger amount, what I mean by that is on Robinhood at least, an option contract is typically represented by 100 shares of the underlying stock. But options may be written in any sort of underlying asset from bonds to currencies to commodities. So they may be written from, like different, any type of, a lot of stocks that you see on Robinhood or a lot of stocks that you see, usually you're able to do contracts with them. You can do contracts with those. I don't think you can't do contracts with currency as far as I'm aware. I'm not sure if that's but from what I know, from what I'm researching, I'm like an beginner intermediate, teaching you what I've been learning. So it's not like I'm not a financial advisor. Perfect time to add that. I'm not a financial advisor. Whatever you decide to do is within your own choice, I should say. And you should definitely contact a financial advisor to help you out if you need any. Boom. So anyways, you can do contracts with all types of shares. Any type of shares. Most types of shares, not any, but a lot. So anyways, you get the point. So let's get back to this 100. So on Robinhood, it shows you that yes, the contracts are they're 100, but the share price that they're going to show on the little side, when it's the little premium and everything that you see, it's going to show singular per share. But just remember, times 100. Times 100, boo. Contracts times 100 on Robinhood, at least. 100 times 100. 100. 100. This is industry standard. Don't forget that. 100. So, my understanding. So basically, we're like BJ's and BJ's customers. BJ's getting a membership fee to get a lot of product at a low cost in the future. So basically, like I said, we're like BJ's and BJ's customers. We pay BJ's to give us a membership so that we can come back in the future and we can get our discounts on that large amount of product. So basically, vice versa. You know what I mean? Like, BJ's has to pay these people a certain amount of money. Okay, we're not even gonna get into that part. But just think about it. Try to think about it like that. Think about it like that. If you're not a BJ's owner, maybe you got an insurance. Maybe you got insurance. Okay, think about it being an insurance investor. Think about, when you pay insurance, right? When an insurance holder and then the insurance company. So you pay insurance in case something happens. You see where it's at right now? But I want to be sure that I'm good in the future. So you pay the insurance company hey. Or vice versa, the insurance company, they're like, oh, okay, we got you covered. As long as you just pay us up this little thing up in front, then we got you. So that's Bree's understanding. Anyways, so you see why I used, think big, not small. But you see why I used a lot of Robinhood's explanation, because the way that I gotta understand things is so specific to my life that it's the world doesn't revolve around you, but I bet you I can make this example revolve around me, though. I bet you I can. Challenge accepted. You know what I mean? It's one of those type of situations. Anyways, so yeah, we're gonna skip this one. It's just navigating through Robinhood. But if you don't use Robinhood, it doesn't mean anything to you. You know what? We're gonna keep it in there. Navigating Robinhood. So you pick a little stock that you're interested in. Oh, put your little ticker symbol. Okay. Then after that, you click trade. Click. Then you click trade options. Click trade options. If you don't see it there, that means your trade options is not enabled. And you should definitely watch another video to teach you how to enable your trade options. Because, boo, you gotta get there. This is about option trading. You know what you signed up for. So anyways, when you first click on that trade option page, it's gonna say discover page. If you click, some stocks don't show it. Actually, some shares don't. It's kind of disrespectful that some of them don't, because I like the discover page. Let me discover. So anyways, no, the discover page, it's nice, little nifty, and I got a couple of little things that they wrote here in the, not here on this page, but further into the slides. And we're gonna, on the discover page, it talks about like if you think it's gonna go up or if you think it's gonna go down. It tells you some suggestions, what it thinks that you should do, and it tells you how to do it and walks you through that. And I love that. It's great. And then at the top is little expiration dates. But we're not gonna go through any examples or anything. I just want you to know how to navigate what we're talking about, because I know some people like to follow along and click it just so it's like I know how to do it like visually to me, you know. So I just wanted to make sure that it's you know, it's easy to read through. I'm gonna stop saying you know and like and lit. Sorry for how many times I already said it in this video. So what is an option contract? All right, so an option contract is an agreement between two parties. An option contract is an agreement between two facilities, a potential transaction on the underlying security at the preset price, referred to as the strike price, prior to the expiration date. So basically, when you look at that first page, if you click on the little, like I just told you when we were walking through the little trade options, how to get there. So if you click there and you look at the trade options, then you're going to be able to click one of the little contracts, whether you decide buy, sell, put, call. It doesn't really matter. You're going to see a strike price and you're going to see the current share price. So when you see that current share price, when you see the price that it's at, it's called the shift price. That is the share price is what it's at now. It's current price, share price, current, share price now, current, present day share price. So then you have your expiration dates. On the expiration date, you're betting for or against that strike price. Strike price is the future you believe it's going to strike at. So that future price, that strike price is that little price that you see there on the I want to say the right, on the left. On the left-hand side, you're going to see that strike price right there. Boom. Well, this is if you're looking from a mobile device. I shouldn't say right or left. But anyways, you're going to see the strike price. The strike price is the price that you believe that it will or will not get to. This all depends whether you're bidding for or against, and this, that, and the third. But strike price. Okay? So the two types of contracts that are there are two types of contracts. Those are puts and they're calls. Both of these can be purchased to speculate on the direction of the stocks or stock indices, or sold to generate income. So both of these can be purchased to speculate in the future, and they're ways that people generate income. They're ways people generate money. This is what we're talking about, stocks making money. So clearly, if you're doing anything on trading or making money, you're trying to make money. You're trying to get to that bag. If you're spending money, you're trying to make money back. So give me my money. You know what I'm saying? So yeah, basically this. Next. So, what are puts? Owners of puts genuinely expect the stock to decrease. Usually, if you own a put, you think that it's gonna decrease in some way, somehow. There's down. You think something low, something down is gonna happen. So, if you own the put, you think it's gonna go down. If I own something and I'm putting it in the put, if I'm taking this and I'm putting it in this little, that little storage bin that you act like, oh, you may need it in the future, but you don't. You ain't gonna use it. Next day you forgot it's in there, and then for years later it's in there. It's in the put. You put it in a little cubby, and then you put it away. You put it placed inside. You put it away. Put it in the garbage. You put it in the trash. So instead of putting it in the trash, what are you gonna do? You're gonna put it somewhere and make some money. You're gonna put it You're gonna put it away to make money. You're gonna put it in the recycling bin to make some money. You put it in the recycling bin to make some money. So that's what I'm saying. But the seller of a put option, they think that it's gonna increase. So they go to the recycling bin and they're like, oh, yes, I can make something out of this. Now this is gonna be amazing. This is gonna be diamonds. This is gonna be straight up fire. You know what I'm saying? Okay, so buying a put option gives you the right, but not the obligation to sell your shares, because you're buying something because you're saying like you're buying. Yeah, if you buy a put option, it gives you the right, but not the obligation to sell your 100 shares for a future strike price. Okay, so it gives you the right, not the obligation. Okay. Anyways, so the value of the put option tends to appreciate while the underlying stock decreases. Okay, so as that option is going down, you're making money. You're making money because you said, it's nothing, and you was right. So now your recycled stuff is making you money. So now somebody basically came to you and was like, hey, can I give you 5 cents for this bottle? And you're like, oh, I was just about to throw it away, but shoot, you gave me 5 cents? Yeah, I'll take 5 cents. What? Of course. So anyways, and then if you're selling a put option, it allows you to collect the premium, but you're obligated to purchase the 100 shares of the underlying stock from the owner at the agreed upon strike price if the owner of the contract chooses to exercise it. So if the owner chooses to exercise a put that you sell, then you have to buy it at that price that they exercised it at. But if not, then you just got to keep the premium. And you also get to keep your collateral, the money that you put up. Now, what are calls? So if I own the call, I genuinely think that the stock is gonna increase in value. I think that if I have the 100 shares, if I own the call, then I think it's gonna increase. Owners of calls options generally expect the stock to increase in value. I expect it to increase in value. I'm the owner of the call and I think that it's going to increase in value. But the buyer of the call thinks that it's going to decrease in value or remain the same. So if I'm selling the call, I'm selling it because I think that it's not really going nowhere, or it's going to stay right where it's at. And I'm trying to make money. So I'm selling it. The buyer of the call, they think it's going to go up. That's why they're buying the call. You get it? So, buying a call option gives you the right but not the obligation to buy the 100 shares at the underlying stock price at the underlying stock price at the designated strike price. The value of a call option tends to appreciate as the value of the underlying stock increases. So while the call goes up, the stock is also going up. If you're selling a call option, this allows you to collect the premium while you're obligated to sell the 100 shares at the price that the underlying stock price to the owner at the agreed upon strike price if the owner of the contract chooses to exercise. So if the owner chooses to exercise this and you're selling a call, then you have to sell your 100 shares for the strike price that you agreed upon in the past. If they exercise it. Okay. Here's a little chart just explaining a little bit what I said. Why am I showing it to you here when you can see it here? I don't know, but you get it. So from my understanding, buying a call means I think that it's going to go up. And if I sell a put, I also think it's going to go up. If I buy a call, I think it's going to go up. Buying plus and buying plus equals plus. Selling negative plus selling negative equals a plus. So then, if I sell a call, I think it's going to go up. And if I buy a put, if I sell a call, I think it's going to go down. And if I buy a put, I also think it's going to go down. Okay. So, basically what I'm saying, if I buy a call, I think it's going to go up. If I sell a put, I think it's going to go up. If I sell a call, I think it's going to go down. If I buy a put, I think it's going to go down. I'm sorry, I'm looking down because this is where my little screen is at. So that's why I'm looking there. Hey, do you like my background? I love this. I love it. Hey, how you doing today? You're good? I'm good too. You see my tree? Look. It's all the little chakras in a little tree, and it's on my manifestation journal. And this is my manifestation pencil and pen. I love that. It's so cute. I love this. Wow, this is so nicely set up so that you can see like part of my life. Hey, what my mornings look like. Mornings and nights. My night is meditation. Okay, I'm not gonna do that in this video. Anyways, anytime that I'm selling a call at the end of the contract, I think that it will go down. Otherwise, I would want to buy it. Okay, so if I'm selling it, if I'm giving it away, it's because I didn't believe in it. Because if I believed in it, I was going to buy it. Period. Because belief matches action. That's just a different story for a different day. But it does also relate to today. Different story for a different day, but it also relates to today. Okay. Anyways, so I can hold it now and sell it for more to someone who believes in it. Or I can do both and it's a win-win. That's called the wheel. Clearly, I said we're not going to get into that. Which is unfortunate because if nobody's into this video, then I guess we'll never get into that. Nah, don't worry. I'm going to go through it with my family. So, we got a little family talking thing. So, you don't got to be interested in this. Somebody is interested. Don't worry. Next. Anyways, so let's talk about rights and obligations because I keep talking about it, but I never even explained it. Like, what are rights? What are obligations? Why do I have the right? Why do I have the obligation? Right? Or is it just me? Am I the only one who was like, girl, what is that? Or like, because I mean, sometimes I just be that person. I'd be like, but what do you mean? But what do you mean? But what do you mean? But what, I'm one of those people. So anyways, rights and obligations. This is a little sentence I wrote up here. Maybe it's going to help us understand it. Because why did I write it up here and not down here? I don't know. Would I edit it now? There's no point. I already did my presentation. I wonder if they thought that was weird too. Past me clearly didn't think it was weird, huh? Anyways, when the owner of a contract exercises it, the seller is assigned it. So the owner can exercise it and the seller is assigned it. So the owner has the right to exercise it and the seller is obligated to be assigned it. Like an assignment, you're obligated to do those things. Exercising. You can, but you don't have to. You get it? You get it? I get it now. Thanks, Bree. Anyway, so it says, rights. The owner has the right to exercise the contract or not, and the seller has the obligation to make good on the contract if said owner assigned it. Or if said owner is assigned. That's what I should say. If said owner is assigned. So let's talk about the strike price, because I talked about that a couple of times too. What is the strike price? What is the strike price? The strike price, I'm pretty sure I did mention it, so I'm not going to read this long slide that explains it. The strike price is the price that you're betting on it being at. When you did the call option, you clicked boom, here's the strike price. This is what I think it's going to be at. Whether you buying a call, selling a put, selling a put, selling a call, buying a put, whatever you're doing, you have a strike price. The strike price is what you believe that it will be at. Above or below is when it gets into puts, calls, buying, selling. But everybody who is looking at the strike price, you're believing this is the price. I'm picking this strike price. You get it? You know what I mean? Anyways, and now, what is the premium? I low-key feel like I explained this, but we're just going to explain it that much more. So, since the owner has the right to exercise the contract or simply let it expire worthless, he or she pays, since the owner has the right to exercise the contract or let it simply expire worthless, she or he pays the premium, the per share cost for the holding of the contract to the seller. So you're paying the premium. That little sentence right there said a lot in little. The premium is what the buyer has to pay to the seller, because I wouldn't be doing a contract if I didn't want to do a little let's make a bet. Hey, let's make a bet. You pay me for this now. If you're wrong, you lose some money in the end. If you're right, you win some money in the end. The good thing is about this bet, though, is you could take it back. You could take that bet and bet it against somebody else, doing vice opposite. You have so much chances to win. Don't sell it. Win. Anyways, like I was saying, as a buyer, you pay the premium, and as a seller, you're receiving the premium because you're the one who has to sell it. And why would you sell it if you're not getting paid in the beginning? Otherwise, you would just keep it yourself. No, you have to hold up the collateral. So for you to have to hold up the collateral, you better be getting something up front. You know what I'm saying? And as the buyer, if you're telling them to hold up the collateral, pay them some money now. Pay them some money now because they're holding up the collateral for you. Don't be selfish. Anyways, sorry. I don't know why I went on a tangent there. Maybe that was about something else that's going on in my life or something. Because I don't know. That was so uncalled for, babe. So uncalled for. So, this is seeming a little bit. I'm nervous that I'm putting too much on at once. But, like, you're gonna watch this depending where you're at in life with trading. So that's the good thing. Anyway, so knowing when to buy or sell. When a when when opening a position, you can either buy a contract with the intentions of exercising it when it reaches the strike price, or you can sell the contract to collect the premium and hope not to be assigned. Buying an option contract makes you the owner/holder of the contract, and in return for paying the premium, you have the right to choose to either exercise the contract, let it expire worthless, sell it back into the market before expiration. The seller of the option contract collects the premium paid by the buyer, but is obligated to buy or sell the agreed upon shares at the underlying stock if the owner of the contract chooses to exercise the contract. Okay, so that's basically what I've been saying just in a long ass paragraph. In a big paragraph. What I was saying was that the seller is assigned and the buyer has the right. Okay, so if I am the buyer, okay, then buyer usually, like, when I see buyer, I see green. So green up, buyer green. And when I see seller, I see red. Sell red. I don't know why. That's just how I happen to see. Sell red, buy green. Okay? So then when I see a put, I think of as bearish, because puts are usually, like, in some way, you think that the stock price is going to go down. Do you want to buy it when it goes down, or do you want to sell it when it goes down? And the call. I call it. I'm calling it that it's going to go up. I'm calling it. I think it's going to go up. So, are you buying it into going up, or are you trying to sell it into going up? You know what I'm saying? It's all your choice. It's all your options. They give you plenty of options. Hence the word option trading. Anyways, so yeah, that's knowing when to buy or sell. Green. If you remember what I just said, if that helps in any way. Green, up. Red, up. Green, red, down. Red, green, down. See, opposites is negative. When you multiply two opposites, you can get a positive. When you multiply two opposites, you get a negative. It's like that. You multiply two positives, you get a positive. When you multiply two negatives, you get a positive. It's weird, but that's how it is. I think everything that you learned in school, just put it towards investing and you're going to know so much. Like, I wish they taught me that this was investing. This would help me with investing and making money, because I would have paid more attention. Now here I am reteaching myself everything that I've learned in the mindset of an investor. You know what I'm saying? Why not just teach us earlier, right? Is it just me? Whatever. Anyway, so if you buy to open a call, you expect the value of the stock to rise. You pay the premium, and you have the right to buy the 100 shares if you do exercise it. When you sell to open a call, you expect the value of the stock to drop, or stay the same. You collect the premium, and you have the obligation to sell it if it does go to the strike price. When buying to open a put, you expect the value of the stock to drop. You pay the premium, and you have the right to sell 100 shares at the strike price if you exercise it. And when selling a put, you expect the value of the stock to rise or stay the same. You collect the premium. You have the right but not the obligation to buy the 100 shares at the strike price if you are assigned it. Okay, so yes, that's You know, and here's a little video recap by Chris Sane. Love that video. I don't think I'm gonna add that in this video, but I'll definitely put that link in the description below, because if you're into trading stocks and learning about it, he really explains it so perfectly, like so well, and he goes with you day by day, and I love it. Like every day he posts a video and tells you what he does. He's very honest about his portfolio. He shows everything right there, and you gotta love somebody like that. You know, you got to because seeing it visually, like a visual representation, really does help me understand the things a lot better, you know. Anyways, and like on here it says, you know, you could ask any questions, but always you could comment any questions you have. I can tell you where I get my information from. If I should do more videos like this, I will. Do you think so? Are you into it? Are you into it? Did I explain it in a way that you understand? Did I like tickle the noggin right there? Just let me know. But till then, watch Chris Sane. I love him. I love his videos. I forever love him and his videos. Not like that. I don't gotta explain. I'm tired of explaining. It's let me not explain. Hashtag let me not explain. Out in these streets. But anyways, yeah, so I know that this feels like it was a lot at once, and I really do apologize for that. But we do need a thick foundation in order to understand more in the future, in our future of learning to invest. And it is best to just get it all in one video. You know, just like a little, like what are they? Oh, okay. And then, you know, just so, this might be a little lengthy video depending how much I decide to cut it. Right now we're sitting about like at 40 minutes. So depending how much I decide to cut, it's a lengthy video. So I know that it was a lot. I don't want you to feel frustrated that I didn't do any examples or anything. But like I said, this is definitely about the foundation. I want you to understand what you're doing. I want you to understand what's going on. I want you to understand those big words, those little words. Here's the investor definition of them. You know what I'm saying? Like, before you do anything, know what you're doing. Especially, like, if you're just getting out of, obviously, you got your feet wet a little bit now at this point with buying and selling out one at a time. Contracts is a little bit different, and they're contracts. Read them. So, this is us reading them. I can do the second half of this. I am making another slide by chance because I have my family stock group chat. If you're interested in that, I know I'll still have the slide, and I can go over that too. And then the week after that, I'm doing an example. So if I should just skip over this, you read it yourself, and you think I should just go straight into the examples and into what I do personally, then definitely let me know that as well. I want to talk to you. I don't want to talk to myself. I want to talk to you too. I want us to talk to each other. Comment, like, subscribe. Comment, like, and subscribe. I don't say that all the time, so I'm saying it now. Yeah, but keep doing some research and investing and trading and all of that, and you'll see it's great. It's great. There's nothing wrong with it. Nothing wrong with it. Peace. No, I'm not.